All right, what is up, everybody? Appreciate you guys for joining us on the live stream. We have a really exciting guest, a friend of the channel. We have had Dan Niles on a bunch of the spaces. Obviously, we know Dan Niles has been a hedge fund investor since 2000s. You can, well, I'll let you go through your whole bio, but this has been a guy who, was green in years, a tech investor who's been green in years when the market was super red and bloody, a hedge fund manager who is managing risk in a way that I don't think a lot of us are thinking about, and also in the same way talking about tech. So I am really excited to have Dan on the channel. Medium intro from me. We'll get better. I'm kind of getting used to these live streams, but Dan, I appreciate you for joining us here. How are you doing, sir? If you could just introduce yourself a little bit, give some of those awesome credentials, kind of why I love talking to you, why CNBC constantly has you on, why these other channels have you on, and then we will jump into it. We already got 60 people in here in a second.
Thanks, Evan, for having me on. Yeah, my background is I'm an engineer by training, have a master's degree from Stanford, had a real job, as I call it, at one point at Digital Equipment Corporation in Marlborough, Massachusetts, doing ASIC design. And then 1990, I had started investing in college, which with my then girlfriend, and turned out to be my wife, and did investment banking from 1990 to 94 and loved it. Switched to the sell side, which means giving recommendations to big institutions on what to buy and sell. In 94, did that for a decade, and then started managing money in 2004, and I've been doing it ever since. So that's kind of my career in a nutshell.
I appreciate you, Dan. Let's hop into it. We only got an hour, and I know a lot of people are interested to hear some of your insights. Tech is the area. We've talked a lot about, the Magnificent Seven and the Intels, the Nvidias. I know we've said some not great things about my Apple. It's definitely has lagged behind, but we're not at a horrible point right now. So if we could just start it out, I mean, first, how you're feeling about, the big names. We had a Netflix earnings earlier today. The stock did initially move lower. I don't know if we want to focus too much into this one, but sometimes it does signal the start to earnings season. Netflix stocks is doing its thing, but how are we feeling about the Magnificent Seven? How are we feeling about the market in general? I was seeing some of your posts, your conversations about kind of set up for a strong move in the kind of medium term here. Small,
yeah.
Even
Well,
an hour different, but yeah, let's do your
yeah. I mean, I think big picture, what we've really seen since, you could argue, since Lehman Brothers failed, and you had the Fed get on quite quantitative easing, and really since COVID, where you had half of US GDP jammed into the markets over the period of 2 years between what the Fed did with the balance sheet and then what the governments did with stimulus checks and the like, you saw, unless you believe a global pandemic is wonderful, the stock market went up 14% in the United States during a global pandemic, and normally it's up 9% a year on average. So that tells you something. And I think when you look at where you are today, you're in a similar situation where you're going to get a rate cut next week. You could argue you're going to get 2 rate cuts next week, in the sense that quantitative tightening, which the Fed has been doing in terms of lowering their balance sheet as well, they're going to end that, given some of the issues we saw, this last week from Zion's, Western Alliance, obviously, Tricolor, and First Brands bankruptcies, and how that impacted the space. And so you're going to get that. You're going to get another rate cut in December. You're probably going to get another one in January. And then you're going to get in May a new Fed chairman appointed by President Trump, who obviously wants rates even lower. So in that kind of environment, it's hard not to imagine the market keeps melting up and finds a way to go higher, rotating from the stocks that are having problems into other areas that still drive the market higher. And I think that's what you're really going to see. I think when you look at Q3 earnings coming up, they should in general be strong, because don't forget, these companies gave guidance for Q3 90 days ago in July when the world didn't look necessarily as in good a shape as it does today. And so they gave conservative guidance, which should help. And then finally, the AI trade is still on in the sense that you've gotten all these deals announced, but most importantly, you've gotten a lot of these video apps launched like Sora 2, where you can generate videos with prompts.
Have you used them yet? I will say Sora and Vio, for me, I'm very low level on this stuff, and I can go in and it just one prompt, it works, it looks good. It feels like this is definitely not where it was over the last couple years.
No,
So it's definitely felt like a jump.
Yeah, no, and this is the worst it's ever going to be. And that's the scary part right now. That's the good news, because things like that video generation is several orders of magnitude in terms of token generation that you're going to need. And so it's going to require a lot more processing power than just a simple, query inside ChatGPT. So that's the positive for the semiconductor companies. The negative is who's going to pay for it? Because you've got 5 billion consumers who are used to putting in a query into Google, not having to pay for it, and they get an answer back. So are you going to get people willing to actually pay? And so if you think about it big picture, you got 5 billion people using Google. Netflix has 300 million subscribers. They generate 45 billion in revenues this year, should have about 9 billion in free cash flow. So 300 million subs, 45 billion in revenues. OpenAI has 800 million users, but they're going to generate only 13 billion in revenues. And they're going to lose about 8.5 billion in cash burn. So OpenAI's got to convince people like you and me, hey, be willing to pay money for a subscription. I think there's a reason why Sam Altman has gone from, we could do things to juice our revenues, like having sex bot avatars on our platform, but we haven't had to do that. He said that in August. And now he's saying he's going to allow erotica on the platform at the end of the year. And I think there's a reason, because they're having trouble getting people to actually pay or pay enough to offset the costs associated with some of this stuff, which is why for me, I go, by the time you get a year out from now, and the market, I think, gets more discerning after you've gone through these rate cuts that the new Fed chairman in May gives you, then I think things are going to get a lot dicier. It could be earlier, but I think the token generation that all of us playing around with these videos and then people in, like Hollywood and other places using it for real, that's going to drive a lot of demand. But again, it comes down to, you got to get people to pay for it in a way that you're cash flow positive. And I think that's when things get a lot trickier next year. So near term, really bullish based on rate cuts. Have some concerns. There might have been demand pull forward, which affects sales over Thanksgiving on the retail side. Right now, things look pretty decent for the most part. Amazon Prime Day sales in October weren't necessarily that good, which is something that gives me pause. But the bigger issue, I think, is probably late 2026, when I think you're not going to get every AI company funded like everybody's going to win, which right now, that's what everybody's assuming, that all these companies are going to win.
What are some of the names in this shorter term period that you find to be on the more interesting side? And we've always been, I mentioned at the start, definitely not an Apple fan, and we've had some thoughts on it. I'd imagine that's definitely still not an area you're in, but in this shorter term period where we're kind of AI is just the name of the game. This might be clip it.
Here's the thing, Evan. I mean, you have a thesis, and then if you're wrong, you just adjust. So with Apple, my view was, who on earth would buy an iPhone 17 when you know that the 18 is coming with AI features, which the current one doesn't have, and you can get a foldable phone, which Samsung has had out since, I think, 2019. I forget. It's been several years, a long time ago. I think at least 5 years ago, they introduced the first one. And so, but at the end of the day, all the data that's come out has shown that iPhone sales are actually pretty strong. Now, if you're willing to ignore the valuation, which pretty much you could say that for the entire stock market, then you go, wow, for the first time, arguably since COVID, they're going to put up numbers that are actually pretty good. And they've only grown revenues cumulatively 5% over the last 3 years combined before this one. And, to put that in perspective, the S&P's grown revenues 26% for the last 3 years combined before this one. And so, at the end of the day, if Apple's numbers are good and you're at that time of year that you end up with performance chasing, and it's been a tough year, unless you came into the year negative, like I did, obviously. I had cash as one of my top picks. And then you got bullish in April, which, kicking and screaming, I went there because the market looked oversold. And my view was it could all be fixed with a tweet, which I said in an interview in early April. You've had a tough time because I think most people came into the year bullish, got more negative in March, April, and then got ripped in this rally that ended up happening. And so now, if you're a professional investor and you're underperforming, you're trying to find names like Apple, whatever it is, a big cap, liquid name where fundamentals sound good, where you can just buy it and hopefully play catch up. So we'll see what happens. I actually was more bullish on Apple next year. I thought it would be actually one of my potentially top picks next year because of the upgrade cycle that I thought would happen, because guys like me have been waiting for a foldable phone forever, and AI features forever. But you know what? People seem to be buying them right now. So I think Apple's actually pretty darn interesting. I mean, if I go through them all, I can just do that quickly if you'd like. I think Microsoft, you saw the massive numbers Oracle had. Microsoft has the right of first refusal with OpenAI. So Oracle only gets the workloads Microsoft doesn't want. So I think they should do pretty well. I think with Google, I think you're going to see great numbers out of them. And I saw the OpenAI presentation today about the browser, but those are all features that Google can add to their search experience as well. And so I think, that one's still very interesting in that it looks like Gemini is doing very well. VO3 is awesome. And the big picture with Google is the ultimate winner in AI is going to be the guy who has the best data to train on, the most data. OpenAI doesn't have any data. Google's got 9 products with over 1 billion users each, and specifically YouTube. And when you put things on these platforms or use them, you're basically signing away all your rights as a user because you get it for free. And so Google's got this massive treasure trove of video that they can train on, which OpenAI doesn't. I think Google's going to be ultimately end up in the winner's circle for consumer AI, especially with the 2 founders back and really working at the company trying to get it going. I think Meta, a similar situation where they started showing ads to their 3 billion WhatsApp users for the first time in the month of June. I think they're going to do great. I know people are worried about, oh my God, Sora 2 is going to cause issues, but I think you're going to see Meta is going to do just fine. And, with Amazon, I am concerned because it doesn't seem like Prime Day went all that well. But I think AWS is going to do great because Anthropic is ramping really, really fast. And so, that's going to be a very tricky one. I think investors will care more about AWS doing well versus them missing the top line, which I think will happen because of e-commerce. But, we'll have to wait and see. And then, with Tesla, as you know, I'm a massive fan of Elon Musk, but the EV tax credits ended at the end of September, and I think Q4 is going to be pretty tough. And then with NVIDIA, I do think at some point we get to a resolution with China, and they'll be allowed to sell chips into China, and that should be good for that stock. So that's a quick rundown of all the Magnificent Seven and kind of how I'm thinking about it.
If I was going to ask you, is there one that's maybe on the higher end of, 1 or 2 that are maybe more in the favorite basket, maybe 1 or 2 that are in the least favorite basket? It sounds like Tesla's maybe in that lower one. It sounds like the competition for the higher basket in the short term is clearly a little bit harder, kind of indicative of this market. But is Tesla the kind of clear loser there? And maybe it used to be Apple in competition for it. But I'd be curious of what you think within the Mag 7, if you had to pick like a long short trade, go long one, go short the other.
I could Tesla is in its own, special little world where Tesla investors seem to be willing to discount out a decade in advance. I mean, do I think the numbers go down? 100%. Do I think the stock might go up anyway? Sure, because I've seen it before. I think it was 2023. Yeah, the beginning of 23. I remember I was positive on Tesla. If you remember, 2022 was just brutal for that stock, right? Magnificent Seven on average were down 46% that year in 2022. Tesla was down even more than that. And I was like, oh, you know what? This actually looks kind of interesting. The multiples come down. And then I remember going, oh my God, the numbers are way too high. They're going to have to come down. And I think estimates went down 50% in 2023. And I think the stock doubled. So this stock, as much as I want to believe it's hooked up to fundamentals in a short period of time, it just doesn't seem to matter. And right now, everybody seems to be willing to try to discount robots and autonomous driving. And, oh, let's just forget about the fact they're going to lose a bunch of money probably in EVs. But yeah, I mean, from a fundamental basis, it's not one I like. I mean, weirdly enough, I think because Apple has underperformed, it's kind of been one of my better ideas right now since the iPhone 17 came out. Microsoft to some degree as well, because if Oracle did this well with the revenues that Microsoft didn't want from OpenAI, how well did Microsoft do with the revenues they did want? Which is what I'm wondering. And quite honestly, I mean, I like Google and Meta too. So I don't know that I have one, because I think in this tape, you end up with an issue like you're seeing with Netflix, where, you know, the numbers really don't change looking forward and the stock's getting hit. I don't think it's that, you know, weird charges or whatever that they have. I think this has more to do. You look at the guidance, you go, my God, numbers barely change. I think that's what's going on. So for me, I've said this for a while, I think you're much better in this type of tape where you're just counting on rate cuts taking the market higher. And I haven't looked at it as of today, but since the day before the rate cuts through the end of last Friday, if you looked at it, the S&P was up 90 basis points. The Russell 2000 was up 2%, but the Magnificent Seven were actually flat. And that's with NASDAQ up 1.5%. So this is from the day before the rate cut through last Friday. So it just kind of shows you that right now the market's rotating into these other sectors, and that's what's going up. And so I think to some degree, if you want maybe the best risk reward trade, it's you own a smattering of the S&P, the Russell, and the Magnificent Seven, and then you just call it a day versus trying to pick like individual names, because with the macro doing what it's doing, you know, if you own only one name and you happen to pick the wrong one, because there's going to be always something that blows up, right? You could just get absolutely your head ripped off in this kind of environment, because by almost any measure you want to pick, valuations are high, and by several measures, they're way higher than they were in 2000 when you want to look at like price to sales ratios or market cap versus GDP, which is Warren Buffett's favorites. These are well above the levels you even saw in 2000. And so if I'm wrong and you have a problem with AI revenues and people start to question some of these circular deals, you could just absolutely get destroyed if one of these hyperscalers comes out. I don't think they will. But if one of them comes out and says, oh, yeah, you know, we're taking down our CapEx, or we really think it's going to be lower in 2026, if anything like that happens, you know, look out, you're just going to get just clobbered. I don't think that's the case, but I think, you know, if you're bullish, you always have to think about what could possibly go wrong. And, you know, it really disturbs me that OpenAI is going, okay, yeah, we're going to put erotica on our platform, because it makes me wonder, well, what exactly are they seeing for revenue momentum?
Yeah, with the amount they are spending there, they definitely need that revenue to become very quickly. I got one more question. I might have lied before and said I had one more question. You kind of mentioned IWM and small cap land, and I'm just curious your thoughts. And you said SPY, MAGs, and IWM in a separate way, not exactly that. What is your general thoughts about small caps as we're kind of heading into that rate cut narrative, as we're heading into an area where maybe this AI bubble, we could call it, or this kind of market kind of continues to extend in this area? Is that kind of where you're seeing that alpha mostly?
Well, that's, as I said earlier, right, Evan, that's where you've seen it from the day before the Fed started to cut rates again after being on pause for 9 months. During that time through last Friday, the Mag 7 were flat and the Russell was up 2% and the S&P was up 90 bips or 0.9%, I should say. So that's kind of what
Is
you
that
are.
where is that where you think that, but do you think that kind of is able to continue throughout this
Yeah.
next quarter? Okay.
Yeah. No, I mean, in rate cutting environments, the companies that in some ways are the worst are the ones that'll do the best. And if you look inside the Russell, it's something like 30 to 40% of them are losing money. So they benefit the most from rate cuts. Google, Apple, Microsoft, most of the Magnificent Seven, they don't care. They're generating tons of cash flow. They could care less where interest rates happen to be. But if you're a money losing company, small cap name, you care a lot because that really helps your health. And people have been saying the small caps, it's about time, but I think you're starting. I mean, a month is not forever, but it's been a month since the Fed cut rates last, and you're kind of seeing that in terms of the breadth improving and going to other sectors. So I've had exposure in financials and industrials and healthcare and all these other sectors because as I look at the market, I go, okay, the market's telling you by the way it's acting. I mean, you can look at Oracle as a good example of that, right? The high for Oracle was the day they reported earnings. And they had a fantastic analyst day a couple of days ago, and the stock got absolutely killed as they took numbers up. Because I think people are starting to question, okay, great, they have all these orders, but where's OpenAI going to get the money to pay for all of this? Or whatever other companies. And so I think you're starting to see a little bit more discernment around this AI theme because all of this sounds great, but a forecast is just a forecast. It means absolutely nothing. I mean, I remember the forecast Cisco had in 2000 that they could grow revenue sustainably at 30 to 50%. And then I think it was 2002 and 2003, revenues went negative for 2 years in a row. And I remember, I think during I think it was 02, they said, yeah, like we're going through a rough period, but when we come out of this, we'll be able to grow revenues at that 30 to 50% rate. And in fact, the number was like half that. So that's why when people go, oh, well, all these luminaries are saying we're going to have 3 to 4 trillion in spending by 2030 or whatever, I go, well, okay, that'll work if we're all willing to have $10 a month subscriptions of OpenAI, but if we're not, then that might be a problem. So that's why I'm kind of, you look at the data points, much like with Apple, right? Like if I get data that says, okay, wow, they're getting a ton of subscribers for Sora 2 or Google, I don't know how they're going to work VO3, which is their version of video generation. But if you end up with a ton of money going to this stuff, then then I'll have to change my mind. But for right now, it seems like there's a lot of tokens being generated at a massive cash burn to get that done for video without the revenues on the other side of it.
I know we got some of our friends up here. I'll let them come in. Ryan, you got any questions, thoughts, anything to throw in to start?
Yeah, Dan, great to have you on. I want to ask real quick about Amazon. You were talking about the different Mag 7s there. Pretty much every Mag 7 is now made in a new all-time high. Tesla kind of in its own world over there, as you were mentioning, but Amazon is notably lagging. Do you have any concerns with what Amazon's doing? Maybe what retail is doing? Pull forward? Anything like that? Is it tariffs? What's going on with Amazon?
That one's easy. If you look at the third-party data on Prime Day, it showed that revenues were up about 6% or so. This is from firms like Adobe Analytics and others. If you look at the estimates for e-commerce for the third quarter, it's for +9. That's a massive gap. And then for Q4, it's for +8. Now, don't forget, Amazon had a Prime Day in July. So the question, and I've mentioned this multiple times on interviews I've had. The thing that concerns me is, has there been a pull forward in demand? Because consumers bought a lot of stuff earlier this year because they were afraid of prices going up due to tariffs later this year. And if you did that, then you didn't need to buy again. And then if you look within the data that these third-party firms have given for what was actually sold over October Prime days, it was more essentials. It wasn't things like electronics. So that's the problem with Amazon in a nutshell. Now, where it gets interesting is the following, which is, if you look at what the biggest issue with the stock has been, they're the biggest player in public cloud. So they have about 50% market share, let's say. And then you've got, Microsoft at number 2 and then Google at number 3. But last quarter, their revenues stayed stuck at 17% growth in the March quarter and then again in the June quarter. Meanwhile, if you look at Google, their revenues actually accelerated at Google Cloud by about 4%, from 28%, I think, to 32% from the March quarter to the June quarter. If you look at Microsoft, their revenues actually accelerated from growing 33% growth to 39% growth. So Amazon's the biggest, but they're obviously losing share by just looking at the growth rates. And so that's where people's concerns are. But the interesting thing is, underneath that, Anthropic, which is on Amazon, they entered the year at about $1 billion run rate. I think they got to about 5 billion or so in August. And the forecast is to get to 9 billion annualized run rate by the end of the year. And then potentially that more than doubles next year. I've seen forecasts that it's closer to tripling. So if you believe that's the case, and you do the math on AWS, you go, Anthropic's going to go from contributing 1% to 2% of growth within that 17% that they did to closer to something like 4 to 5% growth by the end of the year. And so if you look at that, you go, wait a minute, AWS, this might be the quarter that you see acceleration. And, it's tricky with this one because I go, well, how will investors react if they miss the top line? They cut the numbers for guidance for the December quarter. They say e-commerce has been an issue, but then they beat the EPS because the much higher margin business of AWS actually has very strong results. The advertising business has very strong results, and they guide well for even more acceleration in the fourth quarter, which I think is what's going to happen. That's why with Amazon, I think it's tricky, but that's why the stock is struggling, is poor growth at AWS historical to the other two, and then a bad October Prime Day. There's a reason why it's doing what it's doing, and it should be.
Yeah, that makes sense. Hanging out at the 200-day moving average while we're right at all-time highs in the NASDAQ and many other stocks up there as well. The other question I wanted to ask, around a lot of our conversations and people that are much wiser, Monative, I see him up here with us on this subject, but we saw Oracle, what they did at their analyst day recently, Taiwan Semi's earnings the other day. I believe the CEO said, he used the term mega trend with AI still going on. And then this OpenAI that you've mentioned, it seems like every day OpenAI is partnering with somebody and the market seems to love it and seems to chase it. We're seeing, AMD and OpenAI swap equity, NVIDIA swap equity and stuff. Do you have any concerns around that? Or do you think, hey, the market's just going to keep loving this, and as you were kind of projecting, we're just going to keep floating up higher in this AI bubble, as the term keeps being used?
Yeah, no, this bubble, I think, is going to continue to inflate. And the analogy I would give you is, Alan Greenspan had this speech back on December 5th of 1996. It's scary, some of the dates that are stuck in my head. But anyway, December 5th of 1996, where he said the market was, suffering from irrational exuberance. And then the S&P doubled to its peak in March of 2000. And when I look at the current environment, and this is, by the way, despite the Fed starting to raise rates in June of 1999, NASDAQ was at 40% in 1998. It then went up 86% in 1999, and then accelerated even faster to the beginning of 2000, where it was up 26% in the first 2 months and change. So, and there were tons of signs. You had the same stuff going on back then called vendor financing, where Cisco was, Cisco, Nortel, Lucent, Alcatel, they were all doing this, where they were vendor financing to these companies that then would turn around and buy their products. But it didn't mean that NASDAQ didn't go up 86% in 1999. And so that's the similar situation where, to me, this is going to be an absolute train wreck at some point. I think late next year, once the new Fed chair comes in May, he's slashed rates again, and then the easy money kind of stops. I think investors want to believe, because I look at this and I go, OpenAI is going to generate $13 billion in revenues this year. They had a remaining performance obligation with Oracle of $300 billion. How are you going to pay for it? Right? So to me, it's never the data, it's how the market reacts to that data. And the one thing I do wonder about, as I sit here and I go, I think the market keeps melting up, is I go, Oracle stock hit its high for the year the day they reported earnings, and it's been down since then, right? Didn't get there on the analyst day where they dispelled some of the fears about the margins and all the rest of it, and they gave some really big numbers. But I go, is that a sign that investors are starting to think about this a little bit more? NVIDIA's not hit a new 52-week high when the market did. So like there's certain things that I'm watching to go, are we going to have a problem? If you want to think about it in a bigger way, right now, every company involved in AI is expected to win, right? All of them. Well, that was kind of the case in the late 90s. How many actually ended up winning in e-commerce? One, Amazon. Who ended up winning in search? Google, right? You don't hear about Yahoo, Netscape, AOL, Lycos, Ask Jeeves. You don't hear about any of those guys anymore. Who ended up winning in social? Facebook, right? The rest of them are also rants. You don't hear about MySpace anymore, Friendster, 6 Degrees, none of them, right? So do you really think that all of these AI companies are going to win? That's what the market's discounting. I sincerely doubt it. You'll probably have one winner on the consumer side. I think that one is Google, because they have the most training data in the world to train on with YouTube, and it's theirs for free to train on. And I think in corporate, it's probably Microsoft or Oracle, just because they've got the data and the relationships with their corporate customers already. And then I think the rest of them, it's going to be very, very challenging to generate profitable revenues. You can generate money-losing revenues all the time. That's not a problem. It's generating profitable revenues that's going to be very interesting. But much like in the 90s, nobody cares right now because money's plentiful, money's cheap, rates are coming down. They're going to go down even further next year. And much like in 1999, as long as the money is plentiful and cheap, you got circular investments, as they call them today. We called them vendor financing back then. Plenty of debt capital available, which you had back in the 90s, which you have today. Investors want to believe, stocks keep going up. That's kind of what I think will happen. But obviously, you're playing this very scary game of, at least for me, because you have a lot of people go, oh, this is real. I'm going to do 3 to 4 trillion of infrastructure spend in 2030, and like this is going to keep going up. I'm bullish for a completely different set of reasons, which is this is easy money. Investors want to believe, and then when this is over, it's going to get incredibly ugly on the other end of this.
And once again, I appreciate your time coming on with us. The last question, I'll pass it back to Evan or to Stock Talker Monitive. You mentioned 2026 May. That's when Fed Powell is expected to be replaced. That seems to time up with some of the projections that you're giving too. Are those two things? Is that a star aligning potential situation for when this maybe could come back down with the rate cut side of things and maybe the AI inflation starting to come back down?
Yeah, because by then don't forget, Nano Banana from Google came out in August. That's the that's the image editing app that hit #1 on the Apple App Store. And then Sora 2 came out, I think it was September 30th. And so you're going to kind of anniversary that. And so the token generation rates that we all track, you probably start to see them plateau at that point. And so that's when things get more interesting. But, you got to watch some other stuff. You may have seen that Alibaba put out something yesterday where they talked about the fact that they could use 80% less GPUs to train based on this different way they were doing models. And all of these things, they aren't proprietary. Everybody figures them out. And then that all gets dissipated into what all the other AI companies do. And so those are things to think about. But yeah, from a timing perspective, it does kind of feel like it's going to come together then. I hope I'm not being too optimistic that there isn't a pull forward problem for that Thanksgiving through end of year, because it just bothers me. I hope I'm wrong and the third party data is wrong on Amazon, but come in at 6% growth and people are thinking at 9%, it sounds like, for e-commerce. If that's right, that's not a good sign. But Apple's doing well, so I guess we'll find out. But yeah, I think the stars are seemingly aligning then. But you're going to get data points as you go and you figure it out. I mean, maybe it's happens earlier than that, but that's kind of when I think the bubble pops.
Awesome. Yeah, Dan, thanks again. Evan, I'll give it to you, and then if we want to get the others involved.
Yeah, let's go over to Monative. We brought up the Oracle. I definitely want to get stock talk into it. We brought up some of the small caps, and I'd honestly be curious to hear your thoughts on some of those ones. But we talked about Oracle here. Monative, I know you have some thoughts around that one that you've shared on the show a little bit. I don't know if there's a question, any thoughts you've had on what he's saying there, but
No, not so much any questions. I think he called out some of that with the Cisco example that was spot on to what worries me about 99% growth for the next 6 years. I think it's silly to start with, but whatever, right? It probably doesn't matter for the next few quarters, right? Till the till somebody's hand is held to the fire, it probably doesn't matter. But the question I have, again, maybe even this doesn't matter for the next couple of quarters, is you're starting to see special purpose vehicles being used to finance and take these big spends off the books, right? Meta announced one, so that worries me because off balance sheet transactions are by nature opaque, and you could hide a lot of bad news in them. Right, certainly Meta's case, there's a crashing of free cash flow.
I mean, what could possibly go wrong? It's not like you're going to have, fraud in like auto lending or something like that, right? Like, oh, wait a minute, that's what we saw for Tricolor and First Brands. Who knew? I mean, for your listeners that don't know what a special purpose vehicle is, I think it's worth bringing it up. This allows companies like Meta to create a vehicle that then they can borrow money in that vehicle. But on Meta's balance sheet, they don't have to show that as debt because legally it's not something that they have to. So to your point, this adds another layer to the circular investments that we're seeing, where now you can look at a company's balance sheet and go, oh, well, it's pristine. Well, that's because the special purpose vehicle is not on there. And to your point, yes, the cash flow is crashing. But right now, all of these mega cap tech stocks, they're it reminds me of the banks. I remember, I think it was the CEO of Merrill Lynch said, hey, so long as the music's playing, you got to dance. And I feel like these big tech companies, with maybe the exception of Microsoft, because they did, give OpenAI this right of first refusal and said, hey, you can go talk to other people and give them your business. So they didn't want to be on the hook for all of this. But in general, you're seeing all of these guys have this view of, hey, we got to get to artificial general intelligence first. which is kind of the holy grail. And if we don't, we're screwed. So we're all going to keep spending a ton of money to get there. And so you're kind of in this arms race, kind of like the telecoms were, right? If you remember, you had the Telecom Deregulation Act in 1996, which allowed the long distance carriers to get into the local market, the local carriers to get into the long distance market, and the cable companies to get into the telecom market. And they all spent like crazy because they all were convinced they were going to win. And obviously, you only have X number of people on the planet, or in the United States, as the case may be. And so there's only a limited number of people that can win.
Yep.
That's what you have going on exactly. And then it's a great point you brought up with the special purpose vehicles, because that's an added layer on top of the circular investments you're seeing. So not only are you seeing circular investments, they're now being funded by off-balance sheet transactions. And as we saw with Tricolor, First Brands, then you had actually fraud that Western Alliance and Zions talked about this last week. Like, the private credit markets have gotten huge because they are opaque. They're not regulated the way that the public stuff is. And that's why people do it in the private markets. And yeah, you're going to have something much worse than Tricolor and First Brands happen. But it's hard to imagine that probably happens that's not fraud related when you're in a massive rate cutting cycle. Because again, rates went from 4.75 in June of 1999 to 6.5% in 2000. The Fed started cutting with rates at 4.25. I hate this range thing, but it was like 4.25 to 4.5. They started cutting after a 9-month pause, right? So we're in a very different situation today than we were in 1999, and the market still ripped higher in 1999. So that's why I'm trying not to get negative based on things like, what you just brought up, which was a great point, because I just think people will ignore it like they did all of this stuff back in the late 90s.
No, and certainly just the sheer earnings power of Meta, it's still huge, and we just saw that Netflix talked in glowing terms about their ad business.
Absolutely.
So we know that part is safe, that market is safe. So Meta is going to make money. So I'm not worried about that, but it's not a good sign. That was the point I was trying to make, right? It's never a good sign when you want to take it off balance sheet.
100%. And I also, there's the goblin in the back of my brain that goes, why did Meta decide that they wanted to start showing ads to their WhatsApp users for the first time ever in June? Are they seeing something that's making them say, okay, instead of trying to grow users, we want to start to monetize them now? But, that's, I always try to look at what can go wrong. I like Meta. I want to be very clear on that. But, you always want to be thinking about where you could be wrong, what a company's actions mean. And to your point, special purpose vehicles, I don't like that. And then I just go, yeah, the ads to the WhatsApp users is fantastic for revenues, but it does make me wonder why.
Yeah, but in that case, I had family there for a long time, so they've been trying to push WhatsApp payments, and it's been stuck in Indian regulatory for a long time. I know, because my wife was responsible for launching that first time around, and they got stuck because of last minute pushback by Indian competitors, right? So WhatsApp has been filled with a history of false starts. Meta has not gotten what they want to do with WhatsApp. Still they still seem to sort of try this and that, but not have a cohesive idea of what to do with it.
Yep. Yeah. No, it'll be interesting to see how all this plays out.
Yep.
Yeah,
as always, thank you so much. You've been I've been following you for if you remember correctly from your days back in San Francisco. So
yeah. No, Robertson Stevens. That's where I started in 1990. So
yeah.
the good old days.
your boss went to Stanford Management Company, and my wife worked for him there.
Oh, okay. Mike McCaffrey. Yep.
Yeah, McCaffrey.
Yeah.
Awesome. Stock Talk. I want to bring you. By the way, Dan is awesome. If you guys are listening to this and you're enjoying what he's saying, if you disagree with what he's saying and want to say mean stuff to him, you can also tell that on his page, I guess. But go follow him. Check out. He's on CNBC doing a lot of great things, and I'll get that on the screen in a second. But I do want to bring Stock Talk into the conversation here. I don't know if you have any thoughts on it, Mr. Stock Talk. I know a lot of people in here also hear you on our show a lot. What I was kind of curious here, you, I know, have kind of rotated your portfolio into some different sectors here, and there are some general baskets and stuff like that. So I'd be curious to hear some, maybe we talk with some Dan on some of them. I don't know if he's in any of them.
More, I mean, I'm sure Dan knows this stuff when it comes to those mid cap names, but probably more focused on the large cap stuff. We can maybe touch on a name like Amcor later, which is one of the names that I'm long in the U.S. supply chain. I'm sure you're familiar with them. OSAT packager, TSM and Apple partner. But I wanted to pick your brain a little bit on, before we move on to some more specific stuff later maybe, but on just this general idea of ROI in the AI space. And I know this has been, the topic of conversation, right? Like trillions of dollars in spend. Where's the money? OpenAI is not profitable. They're the leader in the space. I mean, I think you went over the figures earlier.
Yep.
Do you think, and first of all, I just want to make it abundantly clear, I agree with a lot of the analogies you're making, from a data or environment standpoint to the dot-com bubble. But do you think that, this real world AI component, the tangible component of this, right? The robots, the self-driving cars, do you think that there's a chance that that is going to maybe extend investor patience with this thematic, because they'll be able to see these products, in a non.com format, if you will, in a non-digital format, being able to see, the deployments we've seen in Austin for the Tesla robotaxi. I was just there this weekend for F1, saw a few of them on the road, saw several Waymos, the robotics deployments that are happening in warehouses at Amazon. Do you think that this will give investors something to hang on to and could extend a little bit of the speculation that we're seeing?
Oh, 100%, because investors want to believe, right? Who wants to believe the party's over? And I think, you saw Amazon stock starting to take off when you saw that news come out on them replacing a lot of workers with robots, right? That came out intraday, and you could see the stock then start to turn and go higher. And so, as I said earlier, it's never the data, it's the reaction to the data. Don't forget, Amazon, I think in the month of June, put out a press release how they deployed their 1 millionth robot already. So this has been going on. It's just what companies choose to put out, because that's what investors are kind of glommed onto. And right now it's, well, OpenAI is going to only do 13 billion in revenues this year and lose 8.5 billion. We got to find something else. Robots. Yeah, that's a good idea. Let's go robots. And so then they put out whatever robot measures they want, and people get excited about that. But ultimately, it has to come down to, as you rightly said, ROI. And that's why you're in this spot, because you're not getting the ROI you thought in the software space or the native AI companies. And maybe this, in terms of big picture, if you look at the 5 biggest guys out there, so the 3 hyperscalers, Amazon, Google, Microsoft, plus Meta and Oracle, those 5 will have spent a cumulative $800 billion in CapEx over the past 3 years, including this one. I'm including because we're near the end of the year. They'll have spent about $410 billion in this year alone, up 60% versus last year. Your native AI revenues, so from the companies that don't have other businesses, so those 5. So if you exclude that and you say, all right, the purely AI-focused companies, the Anthropics, the OpenAIs, et cetera, in total this year, they're expected to generate 20 billion in revenues. So for a cumulative 800 billion spent, you're going to generate 20 billion revenues this year and lose ungodly amounts of money.
Yeah, and I mean, when you put it that way, it seems like, it seems steep. But Okay, so 2 follow-ups on that point for you, and maybe they'll be a little more specific. Quick one. Do you think there's a distinction between when we look at ROI and we're talking about, revenues versus capital invested? Do we think that there is a less, maybe, like you mentioned, native AI revenue versus general margin benefits to these businesses, right? Like when Amazon's deploying more robots, or we're seeing improvements on ad deployment efficiency or targeting, right, that are driving incremental boosts to either profitability or margins in these spaces. Like, is it fair from the investor standpoint for us to say, okay, that is also a benefit of AI, right? It's an earnings benefit more than a revenue benefit.
Yeah, and that's completely fair, but that's a different equation, right? Because if you look at Meta, all this money they're spending is to help their own business. They've arguably done the best of all of them. Because
I would agree, yeah.
Because if you look at last year, I remember I said in the middle of last year, I said, hey, I think we're going to go through this AI digestion phase because you're not getting the revenues. You're training on all available data in the internet. And if you remember in the June quarter of last year, Microsoft, Amazon, and Google all reported. They all took up their CapEx numbers, and the revenue forecast for all three went down for the September quarter. When those three reported the December quarter, the CapEx forecast in aggregate went up, and their revenue forecast again for all three got cut for the March quarter. So now that was because there was no such thing as inference that was picking up, or there was inference, but the training revenues were slowing down because once you're training on all the data on the internet, it flattens, right? Because you don't have extra data you need to train on other than the stuff being produced daily. So there's not this massive ramp up. And then the inference stuff started to hit earlier this year, and then you started a second wave of movement up. So the ROI stuff is mattering. Meta, through all of this, though, in comparison, they were consistently raising their revenue forecast while raising their CapEx. And so to your point, which is a very good one, their CapEx was going up, but it was helping their revenues and their profitability both at the same time. And so they were really benefiting because they were going, oh, what does Evan like to watch? F1 or whatever, right? So we're going to show Evan F1 ads. And we're going to also show him F1 videos because we think he's going to engage with that. So they were using AI really well for all of these things internally, which helped their businesses. Whereas the other guys, it's been sort of hit and miss, right? And so that's why it gets very interesting. But if you're not having your EPS go up while your CapEx is going up and your cash flow is getting crushed, eventually that becomes a problem, which is why Microsoft was struggling last year. And that's obviously improved this year with the revenue acceleration for Azure. But that's, that's stuff you have to keep your eye on. And to your point, which is an excellent one, that's why the ROI stuff really matters, because if you do go back and look at last year, you'll see that, like, NVIDIA done nothing for 6 months because of these issues. And so that's why, like, I'm going to be curious to see how these stocks react to earnings, even more so than the earnings itself. Like, that's why when Oracle gave that guidance for $21 in EPS through fiscal 30, and the stock got absolutely clobbered the next day, I was like, uh-oh. Like, people are starting to question some of this stuff because you can make up any forecast you want, right? I'm going to play at the US Open next year. With my tennis, I sincerely doubt it, but I could make that forecast. So I guess that's what I'm kind of getting to, is for some of them, this will help revenues and margins. But one thing as a counterpoint to this is, at a certain point, you're cranking your CapEx so much. And to Jensen's point, the CEO of NVIDIA's, every time he puts out a new processor, which he's doing once a year now, the value of the older processor, as he said it, like, who's going to want it? So does it make sense that all these companies have been increasing their depreciation lives over the last several years to like 5 to 6 years, when at the same time you've got the CEO of the company, of the thing they're spending the most of their money on, saying, Yeah, every year I introduce a new chip, the old chip is worth nothing. Does it make sense that you should be extending depreciation lives? Now, by the way, that makes your EPS look really good. It makes your ROI look way better. But that's counting magic. And actually, this last quarter, I saw, and it was kind of buried, but Amazon actually lowered their depreciation life after having increased it for a period of time. So these are all interesting things on the ROI front that, when you really dig into it, to your point, it's an excellent one of you got to focus on the ROI. But there are periods where people go, oh, I don't really care because, I'm going to get robots and self-driving cars and artificial general intelligence and all this stuff, and it's all going to be good, and I don't need to worry about
Yeah, I get that. I think there's also an element to this about, I seem to see, I know a lot of people are drawing the analogies to the dot-com bubble because people are just waiting for it to pop, and I agree, it will eventually, and I'm sure you're on the same page, but it seems to me there's also analogies to be drawn here, maybe even to the Cold War and to nuclear weapons development. Like this lack of care about, and I mean, I know in that case, the Manhattan Project, right, wasn't done by a publicly traded company. So it's a little different, right? But I mean, it seemed then that they were like, look, we are on the verge of the most powerful technology ever. We need to be first, right? And it seems that there is a lot of similarities to that in this race too. And maybe that's why there's been such a suspension of need for ROI in the immediate term. But who knows? Who knows how long that'll extend investor patience, right? But I see a lot of analogies to that as well.
Yeah, I mean, at the end of the day, or you can look at the rails, which is the one I look at, and the investment in railroads, and then how that just absolutely collapsed on the other side of that because there was way too much track laid by all of these guys. But I just go back to something very simple. In technology, you typically have a winner take most. That's not how these companies are being valued. Everybody's being valued that they're going to win. That's just
I agree with that. 90% of them won't win. Yep.
Yeah, there's just no chance. But it doesn't mean you can't have a wonderful time investing in that bubble as long as you think it's going to go on. That's what makes it difficult for me because here's the thing, by the way, there's something you said I completely disagree with, which is everybody doesn't think that this is a bubble. You have tons of people that believe there's going to be 3 to 4 trillion in CapEx spent by fiscal 30, right? Like you've seen those industry forecasts in AI CapEx. So there's a lot of people, and I'm sure you've had some of them on this program, Evan, but who firmly believe that this is based in good fundamentals. And that's what it will take. And so I think there's some people like me who, firmly believe AI will change our lives, but we're in a bubble. By the way, that Sam Altman said the same thing, the CEO of OpenAI. But then there are others that go, hey, we're going to get to this 3 to 4 trillion in spending. And they're saying, okay, well, I've got GDP for the world at 110 trillion. And so if 20 to 30% of that is knowledge workers, and then I can improve, you're getting to levels where you're saying, okay, I'm going to look at global GDP and work backwards. But I go, if it were that easy, these software companies will be killing it, but they're not, right? Like this whole agentic AI thing, who's actually done well off of it, right? Last I checked, software was related to knowledge work. So I think I just go back to there's only so much money and how that is going to get spent. And not everyone is going to win, but everybody is being valued like they're going to. And that's when things get dangerous. Especially if you don't have the revenues to finance it. But as we've spent some time talking about, right, you've got special purpose vehicles, you've got circular investments. Thankfully, the biggest spenders are all generating tons of cash flow from other businesses to fund their spending, with the exception of OpenAI. And so you can keep this going for a while longer. And I hope I'm wrong. Maybe all of us who are on this call decide we're going to pay 10 or 20 bucks a month for video generation capabilities. But I think it's really tough when 6 billion, or I think 5 billion Google users are used to being able to put queries in for free and not have to pay for it. So I kind of go back to that, I guess.
All right, appreciate you, Stock Talk. Dan, we're already 3 minutes over, but it flies by when we're having a good time here. I wonder if there's anything you want to leave the people with. We'll definitely do another one of these at some point. Hopefully definitely do another one of these. Honestly, I'm down to do it at some point next month, but definitely we'll do another one this year. So we'll get to recap how everything is going on. But what would you want to leave the people with? And also, one other thing I want to make sure you get out there, is there anything you're working on, any projects you're excited about? Any good stuff like that? We appreciate you joining in. But anything you want to leave the people with, and then anything that you're working on, excited about, that you want to shout out?
Yeah, no, I mean, what I would say is that Mae West had a great saying, which is, too much of a good thing can be wonderful. And I think that's where we're at. Like, it's going to be, I believe, at least, it's going to be a great finish to the year with 2 rate cuts. And you could say that the end of quantitative tightening is a 3rd one for the rest of this year. You get a new Fed governor in May. He's going to want to cut like crazy. You should be able to keep this thing going, spurred on by videos being generated. And so I think stay optimistic and, watch for signs that maybe people are getting a little bit more focused on things. Think about Thanksgiving a little bit in terms of, has there been some pull forward? But in general, just try to stay bullish, stay diversified, because the market will find a way to go up with this kind of easy money coming in. And, we'll see what happens. But I think that's the takeaway, is hopefully people don't walk away going, oh my God, he's so bearish. I'm actually really bullish in the near term. It's just for different reasons than probably a good 50% of the people out there. So that's the only message I would leave you with. And it was enjoyable as always, Evan, talking to you. And the time did fly by. I can't believe it's already an hour, but I really enjoyed it. And
I'm telling you, this live stream format, I think we're going to see the views just while we're live are going to be higher. And then we're going to you're going to see me tag you in a good clip or two going forward. It's going to be nice.
Yeah,
I think this is going to be awesome. But I appreciate you for joining us.
I appreciate you having me on. It's always nice to be able to flesh out ideas rather than the sound bites. So appreciate it. All right, take care, and you guys have a great holidays if I don't talk to you before then. Bye-bye.
Appreciate you, Dan. Have a great one.
Take care.
Perfect. All right. Awesome. Honestly, if you just go in and close the browser there, I honestly want to maybe stay live for half a second as well. Stock Talk, Montev, you guys can go. But yeah, that was awesome. I always enjoy having Dan on. And if you missed any part of that, once we close this down, you can go back and listen to any part of the recording. Also, we're going to clip this up into some nice areas, posted in some different places. But yeah, listen, there are definitely some negative thoughts on there. We've definitely talked about, hey, AI probably is a bubble here. A lot of these names are going to go away, but dance while the music is dancing. And he seems to think we have a rate cut cycle that there is a couple months at least of room.
Well,
Which
we should have more than that. I mean, look, the examples that he kept going back to, right, is the telecom sector. Most people talk about the destruction in software during .com. Actually, the destruction was far worse in telecom sector, right? The biggest names that raised the most capital are companies like Redback, Nortel, which kept buying other companies, right? They bought Bay Networks and a bunch of others. Those companies lost almost everything. Again, the cycle that he talked about, right? We were right here. We had something called the Redback effect in real estate. At one point in time in 1998 and 99, if you put up a new building and Redback found out about it, they would rent it because they were growing faster than they could fit into the building that they had just leased a month ago. That was how crazy it was. The point is, it's got rings of that, but it took a while even for that to fall apart. And this one is built on not just outside money, but internally generated cash. A lot of it is. So it probably has longer legs. But I think what he's also suggesting, which is why I brought up those questions, is There are concerns that you have to pay attention to because those will be the first signs of where the trouble could be brewing here, right? Like the balance sheet itself. Watch how it's going. There is a limit to how much you can load up on the balance sheet. So starting to take it out is not a good sign. Then it becomes very opaque and very. It doesn't tell you the whole story. So things like that you have to watch for. But as long as the primary business is going fine, this could continue for a while. If for example
Martin,
we have a
before you go on,
disruption.
just really quick to that point, remember when you brought that up to him? One thing I noticed is like not everyone. Like I think his response was that like just most retail investors like don't even understand that.
Yeah.
Like you and me could sit off here. If you and me were to sit down and you were to say, "Hey, bro, do you think getting all these transactions off balance sheet to reduce the risk is bullish or bearish?" You and me would agree that that's crazy weird that they're doing that. If they thought that these were going to come to fruition, why are they taking all of the liabilities off balance sheet? Of course it's a problem. But let's be honest, Martin, out of the 23 million new retail investors, how many do you think even know how to do that analysis
No,
or even know that it's off balance
I
sheet?
said this on Spaces. Somebody challenged me and said, no, 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 it has to go on the balance sheet. I said, no, that's why the idea of SPV was even created, is to hide this stuff, right? But it has other advantages too. Now, look, I am just pointing out an example, right? Yeah, you're right. First of all, 99% probably have never heard of it. They probably don't care. I mean, let's be honest here. A third don't really care about the balance sheet to begin with. So, you know, what is off balance sheet is a fraction of a fraction of a fraction that understand it, right? So it is something. It's well because that's why you have more of us that try to understand this stuff, watch it, right? And hopefully we can bring some of this information over. But I mean, look, if the primary business falls for some reason, and we saw this during COVID, that the advertising business went down for 2 3 quarters almost. If that happens, all bets are off, right? Then you're going to take out advertising revenue on Amazon, advertising revenue on Google and Meta, and a whole bunch of smaller players now which are starting to lean more on advertising. That could end this thing, within a year. But we are not seeing that. There are no signs today. There are signs that advertising is strong as heck. So we have to watch for those signs. That would be an early indicator whether there is a problem brewing. All of this is academic for now. All of this is down a few quarters, hopefully, and but it bears watching. That's all I'm saying.
No, and the thing is like
Yep.
Martin, a lot of times when you bring these stuff up on these things or on Spaces, like I never disagree with anything you're saying. Often the problem is just that
The audience is
bull
lost.
markets are forgiving, you know,
Yep. Yeah, yeah, yeah. No,
they're
100%. I
very
mean, look,
forgiving. Like, I mean,
I'm
it's just
also long, right? I don't want it to happen now. I'm just
no,
worried
of
it
course not, of
happens. I
course. I'm not
worry
saying you
more.
want it to
That's
happen
all.
now. I'm just saying like I agree with you that, these problems are there. It's just so hard to know when they're going to come to fruition. Like, let's put this in a scenario, right? Let's say that all these guys are right. Like, let's say Jensen is right, and I don't think he is. But let's say Jensen is right. Let's say Jensen is right that this is just going to accelerate into infinitum, and that every year people are going to buy more. Like, oh, you thought 800 billion was a lot? Wait till 2030. Like Jensen thinks that these guys are going to spend $3 trillion in 2030 between them, right? Maybe. I don't know. I don't know how big their market caps will be by 2030. Are they going to be that much bigger? Maybe, but like that kind of thought is scary to me because it's like, where are we by 2030? Let's say we spend another, I don't know, between now and then, what? This is 2020. We're coming to the end of 2025. So there'll be 2026 calendar year, 2027 calendar year, 2028 calendar year, 2029 calendar year, 2030 calendar year. So let's say by the end of the 2030 calendar year, that's 5 full calendar years. If Jensen's projections are correct, which are way higher than Wall Street's, it would be an insane number. So if you go somewhere, let's say roughly between Jensen and Wall Street's projections, that's it would be in the ballpark of like $7 trillion. What if we don't get AGI by then? Like, what if we spend, $10 trillion and we don't get AGI? Like, what if the LLMs are good? What if they're better, but we still don't have it? Like, what? Like, my question is, how much is the?
Is it just me or is stuff breaking up?
Oh, I cut out there. Can you hear me?
I don't. Yeah, you like disconnected. You're back now.
Oh, sorry. I was on mute that whole time. Yeah, that was pretty bad.
He's gone now.
A lot of background noise. Okay. It happens. I'm sure he'll be back in a second. Montev, did you have a point you wanted to make on that?
Yeah. I'd rather wait for him to finish, but what I was going to say was, if we are actually going to spend the kind of money Jensen expects, let's talk. Finish the thought. He's back.
Welcome back, Stock Talk Disconnect Weekly. It's actually a really funny comment by Victor. He can't hear anything. I need to change the comic so it could look a little bit better. He says he can't hear anything, is what Stock Talk just said. So he is not really back.
All right, let me continue here so we don't have a extended silence here. Look, we have got to almost an annual cadence in product refresh. Let's even, just for the heck of it, say it's 2 years. Everybody wants to demand that newest edge node, right? Nobody wants the 1 generation older, or God forbid 2 generations older, and they'll not pay the same price for it.
So, Montev, my question is what happened to all the H100 chips?
Nothing yet. Nothing yet, and that is what scares me the most about this where we are going, is we have not fully depreciated that yet. The demand is already shifting to B200s, and now or B300s or whatever it is, right? The equivalent in AMD world. And we now have the situation where we are saying that it's difficult to connect power, it's difficult to get cooling, it's difficult to get parts, it's difficult to get transformers. Why would you run the H100 cluster even if it's not fully depreciated? So if we really have these shortages, companies are going to have to think twice about maybe refreshing an existing cluster instead of building a new one, because building a new one apparently has all these shortage related problems. Now, if you do that, you have to take one-time write-offs, because you're turning that off. It's not going to get you any more revenue, or at least it's not going to do so profitably, and you still have undepreciated value in the books. So you suddenly have these large 10, 15, 20 billion one-time charge coming, and that could be coming anytime. And that's a scary part, right? So suddenly you have 1 quarter where the Mag 7s of the world, maybe not all at the same time, certainly not all at the same time, are going to start showing some obscenely bad, just like this Netflix example today, right? They had a 600 million charge, which they could not put in the guidance, but put it as in a separate filing as a risk because it was lawsuit related. It's not a tax, it's a weird thing. It's a lawsuit related thing. So it's a huge miss, but adjusted for that one-time item, it was actually a big beat. Same thing, you might have these one-time items related to writing off clusters that you can't use anymore because of whatever reason, whether they don't generate enough revenue and you need that power and that building for something else, or you have no use for it anymore and you want to toss it and put that building to better use, sell it, whatever it is. If it's not fully depreciated, it has to be written off at that time if it's taken out of effective use. By dragging out the depreciation, they brought this problem on themselves, that you're going to back end some of these charges that could maybe be hundreds of millions over a few quarters of big write downs, or even large write down in a single quarter. That worries me, and that probability is coming. The more the skewed the pricing per unit of time is for an H100 versus the latest. So let's just take the oldest Hopper and the newest Blackwell. If that delta starts getting wider and wider per unit of time revenue generation, you're going to see companies say, I need to get rid of this and fill that data center with Blackwells, right? Because that's, and not only that, you have the next generation, whatever that is called, right? I don't remember off the top of my head, already around the corner. They're already taping it out. They're already testing it. It's going to be here in 2027, early 27. So by early 27, your hoppers are not fully depreciated. It is 2.5 generations older because it's the oldest hopper. Though the capex was not that small, it was not a rounding error capex, right, on hoppers. So you've got this problem that you have to deal with, right? Again, it's not an issue if they could just throw up additional data centers and keep running that. For Microsoft, Google, and Amazon, it's less of a problem because they could just put those old clusters for internal use and rent out the new clusters. For Meta, they don't have external use. It's only internal use. So you will start seeing them have to, slow down capex in some form or do these larger off-balance sheet transactions to take the depreciation off their books altogether. So again, right, it gets complicated when you go into the financial analysis of this, but the risk is not minimal anymore. The risk is starting to become something to watch for every quarter. Am I saying it's upon us? No, I'm not. I don't even know if the risk will come in the next 3, 4, 5 quarters. I'm just saying that the risk has become enough that it bears watching very closely every time we get numbers. All right.
Stock
I
talk.
feel
Do
the
we have any
silence
stock
there.
talk?
Stock Talk has to catch up.
Yeah, no, I don't think he is here. He said he couldn't hear us, so we might have lost him. My question here, and we'll close out in 10 minutes or so. We like the title. This was real. We had Dan Niles on before. Once we close this out, it'll be a whole great thing. Monative asked some great questions. Stock Talk did as well. Emp and everything like that. And obviously Dan was a very smart person during this. We appreciate him coming on, and definitely will have him joining back onto the stream soon. Monative, we talked here. If you were gonna put your guess on it, the guess is probably feels like Oracle seems to be the area you think it might be coming in first. But the question is I think everyone definitely clearly thinks that this AI is going to lead to some huge amount of revenue in the space. But as Dan was saying, this is probably going to be a winner take all. It's probably going to be a Mag 7 led race in this one. And I wonder, I didn't get the chance to ask him around OpenAI, but the market does seem to think that they are setting themselves up to be one of those winners in this space. But there's just so many different areas. I hope I'm Team Perplexity. Shout out. But we'll see on everything. There's a lot of startups, a lot of investments being made. Today's capex is tomorrow's write downs. A lot of that is happening.
How does
But
Anthropic
it
fit
feels
into
like
this picture?
Anthropic could be a winner. It's been accelerating quite quickly. My guess would be we're here this time next year talking about the exact same thing as we've all been saying here, and maybe there we're closer to the end or whatever, but we might be another 20% higher. So I don't know. I think that this feels like an acceleration moment, is my opinion. But
So, look, I thought you're asking me something, but I'll answer it anyway if you're not asking that. In the decreasing order of probability of problems, right? Decreasing order of probability. So the highest probability of problems, I think, is going to be Oracle, just because they threw such large numbers at the analyst community, and it's big shoes to fill. And then, given where the balance sheet is changing, I would put Meta next. And AWS, is not, I think, a problem, but I take Dan's analysis very seriously there, so I'll do some more work on that. So it's AWS, after that Microsoft, and then Google. The reason I put Google last there before Microsoft is I still don't understand the complicated relationship they have with OpenAI. They are now competing, obviously. Microsoft's not providing all the services, so I don't know where that investment is going and what exactly Microsoft has for their investment in OpenAI at this point in time, because they're both selling the same services, and they're out and out competing with each other. And Azure is not the only place where OpenAI is using, and they're making all their own private deals, right? So it's something that I don't understand. I think that could, because most of this investment was made before the structure of OpenAI was changed, right? So from a not for profit to a commercial enterprise. So I don't know that. So that's why I have a problem. Where I'm most bullish about Google, right, is you talked about Anthropic, for example. Google holds just under 15% of Anthropic, right? So 14.7%, I think, the
I
last
think
5
did you see this deal at all in after hours? It was something around becoming a big Google Cloud client as well.
Yeah, they're going to be using TPUs, and I think they're setting up a new cluster with TPUs. But where I'm getting to is the last time Google marked to market their investments at the Alphabet level was 2 quarters ago in Q2. Oh, sorry, in Q1. So since Q1, they're sub 10%, 7 or 8% in SpaceX has also increased substantially, right? Because they did a larger funding round after that with substantially high premium. They have not marked up Anthropic to market, and Anthropic has done massive rounds since then. Databricks has not been marked to market. They've done massive rounds till then. They have not revalued Waymo in a couple of years, if I remember correctly. So just on mark to market within the next 3 quarters, you're probably seeing, by my estimation, somewhere between 10 and $35 billion one-time profit for Google. It's one time. I'm not saying it's going to repeat, well, unless this craziness keeps going, right? If OpenAI executes on everything, Anthropic is not going to be that far behind. Their value is going to keep going up, so that 15% becomes larger and larger, right? So this is the advantage of getting in early. So that's one. You saw Waymo numbers tick up, right? So by those estimates published yesterday, we are going to get to 8 million rides on Waymo a week by 2030. 8 million Waymo rides a week equate to roughly 250 to $300 million a week in revenue. I'm not talking profitability. I'm just talking purely revenue here, right? They might still be unprofitable. I don't know the answer to that, but those numbers, that's what it means, right? So that we're talking about, roughly $12 billion a year in revenue from Waymo, and Google still owns, the vast chunk of it, even after, it's brought in a lot of new investors into the mix. These are things that give me, and the cost structure of a TPU is lesser, even if they don't have the volume anywhere close to what NVIDIA has. They don't have to charge themselves, the 78% margin that NVIDIA makes on their GPU. So their in capital cost of a TPU is much less. So their clusters can be, and they can cut price further, assuming they have the right tools and they're able to get third parties to rent it, which they are more and more. It is an economically more viable solution, and they control that. Sales is still growing for Google. You saw the search market is still, I mean, they're growing search instead of actually, losing that search market that everybody feared. Search market is still growing for Google, and they're, and they're not anywhere close to, giving up on that, right? So all of these things, I'm very confident that Google is safe for now. But then again, I analyze Google to the nth degree every time. So I don't do the same level of analysis for anything else. So, my analysis and the rest might be wrong. But from a risk perspective, Oracle among the five is the highest risk for me, followed by Meta just because I don't like what they're doing, followed by the next three somewhere close enough on risk. Let's put it that way.
Monative, I appreciate you for the in-depth analysis there, the questions. Honestly, the next time we do this, I'm going to ask less and just let us go through the convo. I was honestly just long day, let it go in, but Monative, I appreciate your thoughts as always. Let me share my screen quickly. Let's show just everyone's stuff as well, and then we will go from there. There we go. Let's put this on full screen. Does this look better as well? Yeah, it does.
Yeah, I got a
Shout out Monative. Give him a follow. Although, listen, Monative, I'm going to talk a little crap here. He goes on another stream, spaces a lot when we're live. It's okay. I get it. We will move on from there. But shout out to Monative. Give him a follow. Come on our spaces, not the one that he's on. That is okay.
Only for trading for most part, right? I mean, look, the value I can add, the interest I have is all around earnings. So outside of that, there's not much I can add for the discussion you have. You better people.
Oh no! Oh wait, those discussions are really different. Wolf Trading, they're just doing all live trading all day. I'm a pretty horrible trader. We're starting a little competition soon, and I might start futures trading a little bit. So shout out if you guys want to watch me below a funded account. What'd you say?
I don't even have an account to do futures trading, man.
I don't either, but maybe we learn together. Shout out! This was Dan who was on. If you guys aren't following him on X, if there's any part of this thing that you enjoyed, someone you should be following. But yeah, no, I'm honestly just joking around. I enjoy all the spaces. We got Logical in one over here. We have Martin Shkreli telling people beyond longs are dumb. We got our live stream, 14.5K views. Not bad. Omar, other good stuff going on. But yeah.
Is Beyond the new Korean meme stock? Is that what's happening? I don't understand.
Beyond is
it's AI nuclear rare earth fake meat.
Oh, okay. See, I didn't know that. So,
yes.
So you should have said that. Or they could have very simply said, you know what, this is what the DoD is going to pack in your MREs, and that's it. That would have gotten it where it was.
That would have made more sense than what's happening.
Well, maybe that's the problem, right? These can't make sense. If it does, it won't run.
Krispy Kreme was squeezing in the afternoon today. They just started trying to squeeze any meme stock.
And anything you want to leave the people with? Anything you're excited about? Tesla earnings tomorrow? I don't know. What you got any trades you're watching?
Honestly, I'm not in a ton of trades right now. I mean, we're right at all-time high again. There was some nice setups in the last pullback that I played last week that most of them worked out pretty nicely today. And so, yeah, there's just not a lot that I just love right now in the market. There's some things that are setting up, and there's some things that are on the borderline. So we'll see. I mean, you get a couple more good reports, news, earnings, whatever it is, and you have a lot better look at things. I am looking forward to Tesla's earnings tomorrow. I have no real position there. I don't even think the numbers are really going to matter. I just want to hear the updates of what's going on and watch the show. I mean, I may pop some popcorn and just get ready for Elon.
So the Starmine model, which is basically Refinitive's algo model for predicting earnings beats and misses, is predicting at least a 6-cent beat from Tesla.
I mean, they pulled forward so many with the EV cells that I feel like the numbers are going to be solid. I don't know how the projections can even be accurate. I feel like the consensus is probably a wide range if you had to go and look at each single person and what they think what the numbers are going to be. But I honestly don't think it matters either way, Monative. I mean, the initial reaction maybe, but I think it's going to be the updates around everything else that will actually move the stock.
Yeah. I mean, look, There's almost a completely different cast of characters that come to the Tesla earnings day. So I typically don't even come up as a speaker because the discussion is so far in depth that I don't even know what most of the things they're talking about. So I just listen, right? That it's the one day of earnings where I have less than zero to contribute. So I just listen as a listener, right? There's nothing for me to add. But the data overall, look, we are solid so far, right? I ran through the numbers today. I'm still shocked that Netflix has not recovered. In fact, it's gotten worse after the conference. So it's down now $75.
Yeah, I'll have to check in. What I saw, I don't know if you dug in, but what I saw was there's a tax dispute with the
Yeah,
with
but
Brazil. Is that it? I mean, did
that's
they?
it.
I'll have to check on the call and see if they said
That's
anything more
it.
on it.
Outside of that, it was exemplary in every way. In my, at least in my quick read, right? I have to go dig through the numbers a lot more, but it looks solid. The management was bullish. That one is not something that's a surprise. It was filed as a disclosure, as a risk, right? It was not a tax dispute. It was a strange specific law in Brazil. So they did get a win at a lower court, and this is not that they lost the case. Somebody else lost the case, and now they think the probability that they will be forced to pay that is now higher, so they are accruing that money. That's what it was effectively. So, but it is a one-time item, right? It shouldn't. The street should be able to adjust for one-time items and look beyond that and say, okay, if we don't have it, take this out of the picture, or once this is over, what the numbers are going to look like. And those numbers to me look good. Nothing, it's taken nothing away, right? If we didn't, so it's $1.07 hit from this item. Without that, it would have been, 300 basis points beat on expectations on earnings, right? So
And
I don't
if they
see
get it
what's
worked out, if they get it worked out and it's not as bad as what it currently is, I
true. I
don't know the
mean,
full
look,
situation. I'm seeing if they work out some kind of deal, whatever it is, it could turn around real quick, right?
oh, not only that, think about it, right? If Trump gets the wind of this, he's going to get pissed, right? It's like, hey, you're charging an American company tariff, right? So it's a backdoor tariff of sorts, right? So I don't put it past a Truth Social post coming out in the next few days about this. So yeah, I mean, who knows? I'm just kidding mostly, but it is a one-time item. Get past it, and we should see that Netflix recovers for most part. I mean, look, they are going to make, what did I calculate? Roughly 20, the last 4 quarters, right? They would have their EPS is roughly $26. I gotta take this. I gotta go, guys.
Money talks, money calls. Monta, that is totally okay. Honestly, that I appreciate the thoughts there. I am. Do you have any thoughts on what he was saying, Emp, before I take us in a slightly different direction? Or
No, I mean that was kind of the thing we were half joking about. We were joking about it, about Trump getting involved. If Ted and Greg, the co-CEOs for Netflix, go and
yeah, I was saying stock talk should drive it. Get
lobby,
get
yeah,
like
and
Jared
lobby it.
Kushner.
But honestly, I think Monito's point, while you kind of can laugh about it, I think there's a real possibility. You think about it, somebody's going to put this in Trump's ear and say, "Hey, you've been kind of fighting with Brazil anyway. Did you see what they did to our great American company, Netflix?" And we may get a true social post about this tomorrow. I mean, that I honestly I would put that at like 50-50 odds.
You should make a post. You could be the one that he comments on or like makes the truth about.
Yeah, it'll be my first true social post ever.
No, I'm
Yep,
saying on. I'm
downloaded.
saying on X, just make a post, dear, like at real Donald Trump. I just want to let you know, American company Netflix is having a problem with their whatever. Put in quotes, no, I am not long Netflix calls. It's a fun post.
According to my friend Monative Wealth, it's a backdoor tariff.
Horrible
That's actually a good
tariffs.
post.
They're tariffing us. I think that's a good place, though. I want people to be able to go back through and listen to the recording. I appreciate Monative and Stock
It was
Talk.
a tongue-in-cheek comment. It was not. I mean,
I'm quoting you.
don't put that. Yeah, you guys quoted me already, right? So yeah, I'm just I was just making fun there. But the point is, it's a one-time item, and the company had disclosed the risk, and now they're saying that the risk is coming true, so we have to accrue that money. That's it. It's as simple as that. It's just how accounting should be, right? You think it's a risk, you set aside a reserve. Now the risk is much higher than you thought it was before. So, you take that fund and say, you know what, yeah, we'll accrue it this quarter and probably next, right? So we'll see. Most of this was accrued for earlier years from 2023 onwards. Part of it is for this year. So anyway, so the future, they're already adjusting for this cost. Future quarters, their projections are already now adjusting for it, because now again, right, once they claim that this is real, they can't say, oh, but when does this end, right? They can't do that, so they assume that it's part of running business in Brazil now. So the future, the forward looking numbers are accounted for, but the point I was trying to make is trailing 12 months they're going to make roughly $26, but for this one-time adjustment. So $26 would roughly mean a 46 PE for Netflix. Right? Netflix is still growing substantially. And by my calculation, if you project out next 12 months, they're going to make over $30, which would bring their PE below 40. I mean, some of the mags are right there, right? Apple is not that much less expensive, right? So my point is, it's getting, and Netflix is not as expensive as it once was, maybe even 2 years ago, right? Or even a year ago for that matter. They are growing into their multiples.
Appreciate the thoughts, Monative. I mean, I have no issues. I hold Netflix and I'll continue to hold it. I may even buy some more on this dip, to be 100% honest.
I'm
The
surprised they
live
didn't do that stock
sports.
split. Give me the
Yeah,
stock
that
split.
you talk about wish list items. We get the stock split. That would be, there's them and Mercado Libre are all over that list. There's a few others you could throw in there at this point with some of the other ones that are way up there. Costco, I mean, even Meta at this point. I don't know. It'll be interesting.
You just threw Mercado Libre out there, and I suddenly a thought struck me. Is there something about this internet tax thing or whatever new law that affects them too, or maybe it's only foreign companies? I don't know. I'll go listen again. I'm just curious now. Mercado Libre has pulled back so much from its all-time high, so I think that's also an interesting stock. You just saw ISRG today make up most of the way, right? What is it, up $80, something like that?
Last I looked, it was yeah, it's up 73 still, right at 16% from today's close.
Yeah.
But it's
So
you look at it from how much it was down from all-time high about 30%. It's now back within about
halfway.
12% of all-time
Yeah,
high.
it's
Yeah, just over
recovered
halfway.
halfway. Yeah. Yeah, I mean, all you need is a couple of these to make a quarter, right? As an earnings trade, you need one or two of these every quarter to make your entire quarter worth of return. This would have been your 5,000% trade. I didn't have the trade, so I can only dream, I can only talk. I did not have a trade on ISRG, but yeah, you just need a couple of these to work. All right, I will join you guys and listen to the Tesla earnings call. Like I said, I won't have anything useful to add, but from next week there's a lot. So
Monative, why don't you come on the live trading live stream we do at some point, or the spaces we do, and give some of your thoughts? Doesn't have to be all day, but I'd love to hear some of those trades you're taking too.
So I'll tell you the reason why I'm so comfortable with the people I hang out is, like, I am not the trader. They know that. They put up with it irrespective, right? I'm not, most of the time, I'm not taking an intraday trade ever. If at all, maybe once in, a couple of months, I take an intraday trade, and that's probably more likely that I've made a mistake and I'm closing it before I get into trouble, right?
But
So
Monative, we've been looking at more swing trade. Like we need more swing trading. We have too many people that are in and out futures traders like me that like I do some longer term stuff, but that's more of like the perspective that I think we need to get in there too for our audience because
yeah,
we have a lot
yeah.
of both.
Yeah, let's get through the next couple of weeks and get out
Sure.
of the earning season, and then we can do that. And by the way, I'm going to be off for a while. I have an extended trip to India in November, and I won't be back until next year. So I will try to join. I mean, it's crazy. Now, by the time the market closes, it's like 1 p.m. or something in India, 1 a.m. Sorry, in India. So I'm like, wiped out, and I just want to sleep. So I typically don't join these, but I'll try. It's going to be interesting to finish out the year. So I won't be offline all the time. So at least once a week or so, I'll join just to keep my sanity.
You can't stay away.
I can't stay awake. That's very true.
All
All right, you guys.
right, Monative, take care, brother.
Yeah, you guys too. Take care.
All right, we're gonna
Evan,
close this one out there. I appreciate everyone for joining us. Give the stream a like and subscribe if you are on YouTube. If you're on X, just I don't know, go like the post, comment something below it. Any thoughts from the live stream? We're gonna clip this up, get some clips going, other stuff. If you hear that in the background, as the air fryer, I'm making a little food too. I
Evan,
appreciate everyone. Yeah,
are we gonna have the we're gonna do the Tesla call live on Spaces tomorrow? Maybe get it on
yeah.
a stream.
Maybe we do it on live stream.
I might be able to we'll talk offline. I might be able to make both of those happen together potentially. I have an idea for that. It's interesting. I was talking to Sawyer today on our Tesla Space. We were talking about the questions that the investor questions that get submitted. I know that's one thing that you've looked at a few times. First one is Robotaxi, Megapack, car model. They're all over the place. Optimus, third row SUV, which I know probably won't get an answer, and then the affordability with global politics. Those are the main ones. There's another question about Samsung, the Samsung chip deal. That'll be interesting. Plus, Elon's got the vote coming up November 6th, so you wonder if he's in a good mood tomorrow. Maybe he's a little chipper. Maybe we get a happy Elon tomorrow.
We will find out. But here's what I will say: there's some stuff going down on the Slack, so I'm gonna close this out. I appreciate everyone for joining in. I got some work to do. We got some more guests. If you enjoy these type of speakers, we want to do more of them. Dan was insightful, awesome. Yeah, Jordan, we're definitely gonna be having people like him on more. Thank you, Emp, for helping me out. And yeah, we will catch you all on the next one. Have a great one, team.